Hi, welcome to Academic Market Insights. I'm Dr. Russell Rhodes, joined by Dr. Larissa Adamiec, and it's a rarity. We're actually in the same space. Figured if we're going to be in the same space, we may as well record some videos. The Bears play tomorrow night, and we're recording on a Sunday, so nothing to do on this Sunday anyway. And this episode 7 of our personal finance series, is going to talk about installation, administration, and termination of qualified plans. You're going to hit on a few things there's a lot of documentation involved in all of this. You're going to talk about that. You're going to talk about what the requirements are for self-employed participants, etc., and any forms that may be involved in this whole process. And with that, you're going to tell everybody to hit the thumbs up and subscribe and everything because you're nicer than me, and they're going to take it from there.
And my kids love it.
Yeah, they do. So
That's, one of their favorite things.
I'm handing it off to you. It's all you.
Okay, excellent. So this is one of my favorite topics for anybody who knows me because, what's going on here? Okay. The reason why this is one of my favorite topics is because I love documentation. It's like a weird part of my life that
I
like
gotcha.
I've just done. When I put together an equity fund, I learned what documentation for putting together these types of things was, and I was just blown away by the intricacies, when they're intricate,
Hmm.
and the importance of it. So having a well-written plan is unbelievably valuable, and I hate to say it, but it also protects you against being sued.
Yeah.
So it's
Yeah.
like a really unique
Hmm.
risk adjustment, or for those who are looking for risk protection, having well put together plans is critical. Okay, and investors love them, and your employees love them.
And I'm just going to loop back to what you said about not getting sued. I probably bring that up more than I should in classes. But if you're in the financial world, there are a lot of rules that you need to follow. There are rules that people, maybe have been neglectful and forgotten to sign a form or something like that. And if you've ever seen the fine print on if, failure to provide this documentation could result in, a $500,000 fine and 10 years in prison for each, which just sounds extreme. They've used that to prosecute some people that in the past. So don't think that it's just extreme. I always like to say, remember Al Capone got it for tax evasion.
Well,
So just it's important. And if you have a plan up front, I know I'm stepping all over you here, but
that's
if you have a plan up front and your client is upset with you, and you can refer back to the plan. If there's not any documentation in place and your client's upset with you, it's going to be much more difficult to justify what you did to make them upset with you. So there.
and to piggyback on that,
Mhm.
people are going to be more likely to believe your client who has a complaint.
Oh yeah, yeah.
And so it's so important to have a good documentation, because again, if you're in the he said, she said kind of situation, and there's a form already pre-filled out and
Hmm.
signed by both parties, then you have a case so that you're protected. Okay.
Sure. All
All
you.
right.
Yep.
So what we're going to be looking at is establishing objectives. And I feel like this, or at least in the investment world, is huge. Like it's so important to understand really what types of assets, what your goal is,
Hmm.
what your index that you're looking at. You should prepare an employee census. And again, coming from an investment standpoint of why would you do this? The reason why you do this, and we'll talk a little bit more about this, is so you understand the needs of the employees. If you have a group of, I don't know, the majority of your employees being young and not close to retirement, you might want to set up different objectives.
Hmm.
You're going to look at plans, different types of plans to achieve those goals. You're going to assess each financial or each of the characteristics of the plans. Now, here's where it gets a little dicey, right? Let's say that you don't have a background in finance.
Hmm.
This is where you would maybe hire a consultant,
Hmm.
because again, if you have a consultant who signs off on it, then it looks very different than if it's just you willy-nilly saying, I think this plan works best, and you don't understand. It also helps eliminate conflicts of interest.
Mhm.
And then finally select a plan. Okay. So objectives for the plan. Your objectives should be really to benefit both the owners and the employees. You're looking, and this some of the other objectives is to really encourage employees to come work for you and then to stay working for you. Sometimes some institutions have plans that are designed specifically to encourage people to retire early. I know at a university I was working for, they were looking to get tenure track faculty members to retire early, so they offered specialized plans. So if you retired, if you were within such and such years of service and of age, they would give you an additional 3 years of severance
Mhm.
to encourage you to say, okay, I'm going to step down. You also get the benefit of the tax benefit, or the tax advantages of the benefits. Something that this doesn't go into is you might be also more interested in what is the classification of the types of assets they're going to be investing in. And I think that's something important to understand as well. So you're also, and again, this is where good documentation comes in.
Yeah.
What are the costs associated with it? What is the cost for the administrators? How flexible? What are the investment risks? And if you've ever, so you're into equities,
Hmm.
you've read many 10Ks, and they include different types of investment risks. Understanding these and being able to include them and document them within the plan, again, protects the employer from any disagreement or conflict with the employee. And then this is key, any mandatory funding that's required, right? Because if especially if you're looking at a defined benefit plan, so like a fund, and there's a certain amount of funding that's done on an annual basis, having that clearly laid out and clearly laid out on where that funding is coming from is critical.
Mhm.
So there could also be clauses in there that say, okay, if we don't hit a certain EPS, we're going to utilize retained earnings or something along those lines so that it's very clear where the funding is coming from. So you're not in a situation of saying, well, we didn't have the money,
Mhm.
so we're not going to do anything. No, you have a plan, you've thought these things through, and now you're looking to execute them. Whew.
Wow.
Yeah,
There's a lot going on here.
yes. And it's funny where
Mhm.
you kind of laugh, but if you ever look at like an ETF or a mutual fund,
Oh my goodness.
oh my
Yeah.
goodness. Yeah, they list out all of the costs, right? And all of this stuff costs money. So not only are you looking for plans that are well documented for things such as risk and other things like that, but you also really want to understand what the costs are because each of these plans are going to have different costs.
Mhm.
The cheapest isn't necessarily the best. The most expensive isn't necessarily the best. And that's where really understanding these and doing a comparison analysis of these plans is critical, which is one of the steps. I think it's like 4 or 5 steps. Okay. So our bundled provider functions, we've got duties, record keeping, administration, investment management, and reporting and
Mhm.
disclosure. Now, Dr. Rowe and I come from a world where the investment management piece is the piece that we would be spending more of our time really focused on.
Yeah.
What assets are we going to invest in, or what asset classes, and then specifically what assets? Do they align with the objective of the fund? So if
Mm.
we're looking at large growth, we're not going to be putting any penny stocks in there.
Right.
And that would be a violation of the plan itself.
Mhm.
So in these types of plans, because you're going to be investing more in mutual funds and structured products such as these, because it is an employer program or plan, you're going to be looking to make sure those assets align with the objectives. So again, if we're looking at choosing mutual funds, you might want to go with the targeted age. These are the structured products that say, oh, well, I'm going to retire in 2045. What asset distribution of assets should I have? If none of your employees are going to be retiring in 2045, you might not even care to have that as an objective. And then reporting and disclosure. And Dr. Rowe really brought up a great point about people being what is it? Being, if you don't sign documents and don't fill this out correctly,
Oh, yeah.
you could be tried. And that's partly because of Sarbanes-Oxley. So
Yeah.
now all of a sudden, on all of our financial statements, the CFO has to sign off on it. And if there's a mistake, the CFO actually takes responsibility for it, which is an improvement because before the
Yeah,
CFO would
that
say,
that whole nobody went to jail over 2008 thing.
yeah,
Yeah, well, they've made some laws that would create a situation where some of those people may have gone to jail, but
right.
yeah, and I'm sure there are people, well, why don't they go back after them? You can't change the
Nope.
rules.
Nope.
That's just that you don't want a government that changes the rules on you. That's for
No,
darn sure.
no, you don't want a
Yeah.
situation where you're like, oh crap,
Yeah.
the law has changed and now I'm guilty.
You know, I
Okay.
I drove 30 down my street and that's the speed limit, and they changed it to 15 today, so I got a ticket for yesterday.
Yeah,
That's an
exactly.
extreme example, but there you go.
But a good one.
Yeah.
So again, adopting a written plan. I most likely what you're going to be looking at is utilizing a third party to do this. You can write your own plan. It's not necessarily recommended. You do want a CPA or an attorney to approve it, to go through it. You could even have, or most likely you would have, these things notarized to make sure that, yes, this was written by an attorney.
Mhm.
It doesn't put the full responsibility on the attorney or the CPA, but it does enhance the credibility of the documentation itself. You also now need to notify your employees.
Yep.
And it's weird that we're making a stink about this, but it's how do you create a systematic way of notifying people? And this can include things like making sure that we have an email system set up, making sure that there are letters written and that those get sent out. And these, anything, things change, but also if there is just your regular statement. So on a monthly basis, you might be getting a statement saying this is how much assets you've
Mhm.
had, this is the performance, these are the things you need to know. But that information needs to get pushed out to your
Mhm.
employees. And having a system that automatically does it for you, hugely beneficial. Again, your statements, these should be automatically sent out, but the employee or the benefactor should be able to request them anytime they want. So this is not something that, yeah.
I think they can. I think you can actually request like every transaction that happened in your. There are lots of things that you
Mhm.
actually have the right to ask for that a lot of people are not aware that they have the right to ask for.
And part of the reason why they're not aware of it, they don't necessarily need it.
They don't need it. It's also in the fine print.
Right. It's just one of
Yeah.
those things like how many people really want to see all of the transactions in a mutual fund?
I've had clients like that, but
Okay.
that's why I'm in the academic world now.
Yeah.
So there you go.
But the majority of your clients probably do not need to see
Hmm.
this or care to see this. So we've had the Pension Protection Act of 2006. And I thought that this was interesting that the benefit statements, at least once every 3 years for everybody that's been vested. I would have thought that this already existed prior to 2006.
You would have, I mean, you would think it's something that people would just naturally be doing, but maybe it suddenly became required. I feel like we get it once a year at minimum,
Oh, I do too.
and I actually just got the notification from IU to the election benefits for next year, and we're on a even though we're an academic institution, we're on a calendar year, first week in November.
Hmm.
And that will, the health insurance, everything else,
Yep.
but this will come up as well.
Right.
Yep.
So
Ooh,
investing
I like
plan
that.
assets. I know. Be diversified.
Mhm.
You want your assets to be materially different with a return and risk profile because we live in a two-dimensional world of returns and risk. We don't really. There's other dimensions, but
There are many. Yeah, we start with two dimensions on
right,
paper, and then it's a three-dimensional world.
right. But it's a kind of a joke. Like when you start with the
Yeah.
Markowitz theory, returns versus risk, and really understanding that. And then understanding the benefits of combining these assets because those combinations, because of the correlation, it helps reduce overall risk. So again, understanding the assets, and if you don't understand this as in your employer, it's very reasonable to utilize
Mhm.
a consulting service or another third-party service just to do these things. And then this is interesting. So if there are discrepancies
Oh yeah.
and right, because sometimes you pay too much, sometimes you pay too little, and then understanding the processes for making sure those things are going to be paid. And this could be payments for investing schedules. So again, that mandatory funding, or even to the fund itself and making sure that all of the costs
Mhm.
were completed. So some of the fees that we talked about earlier can be flexible,
Mhm.
right? So you've got a straight management fee, which is just let's say a straight dollar fee.
Mhm.
But some of these other fees are going to be based on as a percentage of assets under management, and those are constantly changing. So as more employees invest more, your assets under management are going to grow. As your employees start to withdraw their funds, your assets will decline. So as a result, you're constantly updating
Mhm.
those expenses. So correcting excess annual additions. So this is how much you're looking to actually make those corrections. And then, in accounting, we always had what's called the slush fund.
Yeah.
And it's the idea of like, well, let's put away some extra money just in case that this comes up and
Mhm.
we're not surprised with the bill. Um, if you don't have a personal slush fund, I would recommend it. They're great for like, oh, the basement flooded. Like, oh, that's a super fun thing that I have to pay for.
Mhm.
And having, yeah, and having
I
the
don't know why you had to use the basement example.
basement. So
Go
just
ahead.
in reference, last year, both of our basements
It's flooded.
flooded. Yeah. And it costs money.
Yeah, it's not, it's wonderful when, you have a $20,000 expense that you didn't anticipate.
Nope.
So there.
Yeah.
Okay.
So slush funds are great. So you also want to look at calculating the employee individual's contribution rate. And it's just a simple rate of the contribution rate to other participants over one plus the contribution rate. Uh, this is also, you're going to need to be able to calculate the self-employment tax. We're going through these things quickly, not because they're not important, but because most likely you will be utilizing a third-party company to be able to do these things. And again, the self-employment tax is based on how much you're making, and which is one of the reasons why these things need to be evaluated periodically so that you can really make sure that it's correctly done. More individual contribution, and then forfeitures. This is always interesting to
Mhm.
me. So for defined benefit plans or pension plans, these will then could reduce the plan cost. So
From the sponsor side.
right from the
Yeah.
sponsor side. Now, for contribution plans, it might be used to cover administration costs. It might be allocated to the remaining participants, and you want to make sure in your documentation that it's clearly spelled out what's going to happen to
Mhm.
those. Because obviously, as a participant, I'd rather have the money allocated to myself. Uh, and that's always like an extra little bonus. Disqualified people.
Ooh.
Yeah. So not everybody can participate in the plan.
Huh.
No.
There's a couple on there that I'm surprised at.
Well,
So,
and like members of the family, and this was, I will define this later in the series, but
mhm.
family membership would be if you own over 10% of the company, or if you and a group of people, your family owns 20% or more of the family.
Mhm.
Um, so it's really this idea of removing any of that conflict of interest, because if you are such a large shareholder, you might be more swayed to make sure that the plan is
Okay. Yeah.
more conducive to you.
Yeah.
And that's reasonable, which is why we have these rules put in there.
I like the member of the family one.
Yeah, that's what the one word
Well,
just.
and we know I'm a big movie person, and this is not a financial movie, but Shawshank Redemption,
Ah,
when they're on the roof and old Andy Dufresne asks the really mean guard if he trusts his wife. There are lots of situations where
it
people,
comes up.
yeah, I know that there have been insider trading situations where you use the wife's account.
Right.
That sounded like such an old guy thing to say, but I've just seen a couple of instances where the spouse may not even know that that had been going on.
Sure.
So there.
Yep. And so they don't want you to do that.
Yeah, no, I mean, that's where the member of the family thing comes from
Yep.
right there, is because you do have a benefit from that.
So prohibited transactions, and this is the idea of uh, assets within the fund itself,
Hmm.
and what is allowed to be lent or borrowed on the for the plan itself, goods and services. So the relationship, if you are utilizing a third party, how are you getting that
Hmm.
acquisition of a plan? Because you could be, if you're, especially if you're a firm that's buying another firm, you're going to be potentially acquiring a existing plan. So these are all transactions that have to be utilized, and you want to make sure you have a provider that has well documentation of how they're going to handle each one of these things, really to protect you and the employee.
Yeah.
Fiduciary liability. I think the word fiduciary is one that is put out quite a bit and is used to make people feel warm and fuzzy inside.
Mhm.
But it is the idea of how are you managing that money? What are you doing about it? And who is liable and who is responsible for it? And so especially when you're dealing with financial transactions, the ability to get in there and possibly steal, it's something that we're very cautious about,
Mhm.
right? So if anybody's worked in the financial markets, we all know we have to get thumb printed, right?
Yeah,
First day of the job, go get your fingerprints.
and then explain what came back.
Yeah, exactly.
Kidding. Keep going.
Yeah.
Yeah, I can't help myself. Talk to somebody that used to work in HR in the financial industry, and they'll have all kinds of fun stories of
They-
goofy things people have done.
Yep.
Okay,
And
go
you
ahead.
have to. And then understanding how to amend or terminate a qualifying plan. So again, when we talked about the possibility that a plan could change because the company's been bought or sold, and you're going to utilize different people within there. Also, law changes. I like Dr. Rowe's example of the speed limit changing from 30 to 15,
Mhm.
because you're then going to, in some cases, you actually have to do some things retroactively. So if it's a change in reporting, you might now need to create past documents so that there is a history of it for these documents going forward.
Mhm.
Because if you change the documentation, let's say you change it in September, well, January through August, the documents are going to look different than starting in September. And if you're a person who doesn't understand the changes, you can't compare then
Yeah,
how your performance has changed. So in some cases, you actually have to do some backtracking and create some retroactive
it's more work than you
documentation.
should have to do for that.
Right.
That shouldn't be your responsibility.
No, it
Yeah.
should be the plan administrators. And this is our last slide, and it talks about the unfortunate situation when involuntary termination has happened.
I know somebody from GE that this happened to,
Yeah,
that they got their lump sum. They'd been there for about a decade.
and so
This is
lump sums
mhm.
do occur, and then and especially with these types of plans, that lump sum you're going to want to roll it over. And or let me ask you, what happened to that person from GE? Did they
They
just get it in cash?
no, well, what happened? Yeah, they ended up. It was in GE shares, which was unfortunate
Mm,
because they left when GE was like in the 30s, and I think it was maybe even single digits at the time.
I was to say, I thought it was like
And somehow, and they had moved around a bit, so they finally caught up and said, do you want to cash this out or whatever? And they felt like they could do better with it than what they could do leaving it in GE stock, and they did have that alternative, and they took cash and put it in an S&P 500 fund.
right.
But that was the lump sum. It wasn't a cash payment. I think they may have sold the shares and given them a check, and the check went into an index fund.
And so what's really though we're seeing is that it's a dissolution of the plan itself.
Yeah,
So we're
yeah,
no longer looking at the retirement
mm,
plan. You're not looking to get those funds when you turn 65. You're getting them right now.
exactly.
And those are not
And there were
typical
and that
situations.
and I'm doing a little recollection here. There was a tax implication of taking the
Mhm.
cash, but they felt like they'd rather go ahead and take the cash because they didn't have a lot of confidence in General Electric at the time.
Well, and I believe GE got down to like $8 or $9 a share.
I feel like this happened near the low,
Yeah,
as it often does.
as it usually does.
Yeah.
So with that, if you like this video, please hit like. And if you haven't already, please subscribe. Thank you so much for joining us.